Welcome to the exciting world of ETFs, where giants like SCHD, VOO, and JEPI battle for supremacy. Today, we dive into this thrilling arena. Exchange-traded funds, or ETFs as they are commonly known, are not just any financial instruments. They're like the Swiss Army knives of investing, offering both the diversification of mutual funds and the flexibility of individual stocks. ETFs are essentially baskets of securities that are traded, just like individual stocks, on an exchange. Their value fluctuates throughout the day as the ETFs are bought and sold. This is why they are so essential for investors. They offer an easy way to get diversified exposure to a broad swath of the market, a specific sector, or a specific strategy. Now let's meet our contenders. In one corner, we have SCHD, the Schwab US Dividend Equity ETF, a heavyweight in the dividend-focused ETF space. SCHD seeks to track the performance of the Dow Jones US Dividend 100 Index, a benchmark that includes high dividend-yielding US stocks. In another corner, we have VOO, the Vanguard S&P 500 ETF, a titan in the world of ETFs. VEO seeks to track the performance of the S&P 500 Index, one of the most widely recognized benchmarks in the US equity market. Finally, in the third corner, we have JEPI, the JP Morgan Equity Premium Income ETF. JEPI might be the new kid on the block, but don't let that fool you. It seeks to provide investors with steady income through the use of a covered call strategy, an approach where an investor sells call options on an asset they own to generate income. These three ETFs, SCHD, VOO, and JEPI, each offer unique investment strategies, and they each have their own set of strengths and weaknesses. But which one comes out on top? That's the million-dollar question, isn't it? Stay tuned as we unpack the strengths and weaknesses of SCHD, VOO, and JEPI. The winner might surprise you. Thanks for tuning in, viewers. If you're finding this content valuable, there's so much more to come, filled with even more amazing tips, tricks, and inspiration. Make sure you hit that subscribe button to stay connected with us and never miss out. And while you're at it, drop a comment below and share this video with your friends. First up in the ring, we have SCHD, a dividend ETF heavyweight. Here's why it's a tough contender. SCHD, or the Schwab US Dividend Equity ETF, is a popular choice for investors seeking both income and potential growth. It's unique for a variety of reasons. One of the major selling points of SCHD is its focus on companies with a record of paying out dividends. These aren't just any companies, mind you. These are firms with a 10-year history of paying dividends, providing a level of security and stability that's hard to ignore. But there's more to SCHD than just dividends. This ETF is also known for its broad diversification. It's spread across a wide range of sectors, from healthcare and consumer staples to technology and financial services. This means that even if one sector takes a hit, the impact on the overall portfolio could be cushioned by the performance of the others. And let's not forget about performance. Over the past decade, SCHD has consistently provided investors with solid returns. In fact, it's often outperformed many of its peers in the dividend ETF space, making it a formidable player in the ring. Now, what about the dividends themselves? Well, SCHD offers an attractive yield. At the time of recording, it's hovering around 3%. That's significantly higher than what you'd get from a standard savings account, and it's competitive with many other dividend ETFs. So, why might investors choose SCHD? It's simple. This ETF offers a 1-2 punch of potential growth and income. It's backed by solid companies, offers broad diversification, and provides a competitive dividend yield. Plus, it's got a track record of performance that's hard to beat, but the financial world isn't a one-horse race. There are other ETFs out there vying for the top spot. So while SCHD is a strong contender, the question remains, how does it stack up against the likes of VOO and JEPI? With its focus on dividends and stability, SCHD is a strong contender. But how does it stack up against VOO and JEPI? Let's find out. Now let's turn our attention to the Vanguard behemoth, VOO. This ETF is known for its broad exposure and low costs. But is it right for you? VOO, or the Vanguard S&P 500 ETF, is a titan in the ETF world, boasting a mammoth size and a reputation that's hard to beat. The fund aims to track the performance of the S&P 500 Index, a benchmark that represents 500 of the largest companies in the US economy. These are companies that you interact with on a daily basis, like Apple, Microsoft, and Amazon. One of the unique selling points of VOO is its low expense ratio. It's one of the cheapest funds to own, with an expense ratio that's a mere fraction of a percent. This means you get to keep more of your returns, which can make a significant difference over time. But it's not just about the low costs. VOO's performance history is also impressive. Over the past decade, it has consistently delivered strong returns, reflecting the overall growth of the US economy. It's a testament to the power of buying and holding a broad-based index fund. And let's not forget about its sector focus. VOO's portfolio is diversified across a variety of sectors, from technology and healthcare to financials and consumer discretionary. This broad exposure is a key part of its appeal. It means that instead of trying to pick individual stocks or sectors, you can simply buy a piece of the entire US stock market. However, it's important to remember that VOO, like any investment, comes with risks. It's subject to the ups and downs of the stock market, which can be volatile. And while its broad exposure can be a strength, it also means that it's exposed to any downturns in the US economy. So, is VOO the right ETF for you? That depends on your investment goals, your risk tolerance, and your belief in the long-term growth of the US economy. VOO's broad exposure and low costs make it a popular choice. But does it have the edge over SCHD and JEPI? Keep watching. Finally, we have JEPI, the new kid on the block. This ETF has been making waves since its launch. Here's why. Let's dive right into the unique selling points of JEPI. Unlike conventional ETFs, JEPI leans towards an innovative approach known as the covered call strategy. This strategy allows the fund to generate income by selling call options on the securities it holds, a method that can potentially yield higher income during times of market volatility. Now that's an interesting twist in the world of ETFs, isn't it? Since its inception, JEPI has been striding with promising performance. Despite being the newcomer, it has shown a reassuring level of stability and growth, swiftly gaining the trust of investors. It's not just about the returns, it's about the consistency, and JEPI has been delivering on both fronts. So, why might investors choose this ETF? Well, apart from its innovative strategy, JEPI offers a monthly income distribution, which is a boon for those seeking regular income. This feature alone sets it apart from many of its peers, making it an attractive option for a diverse range of investors. Let's talk about the sectors it focuses on. JEPI is not one to put all its eggs in one basket. It spans across various sectors, including information technology, healthcare, and consumer discretionary, offering a well-diversified portfolio. This wide sectoral spread provides a balance, mitigating the risk while still reaching for attractive returns. Speaking of returns, JEPI has been quite the performer. It has offered competitive returns, keeping pace with, and sometimes even outperforming its more established counterparts. Now that's a feat worth noting for an ETF that's still in its early days. With its innovative approach and strong returns, JEPI is making a name for itself. But does it outshine SCHD and VOO? We're about to find out. After a thrilling showdown, it's time for the verdict. Who comes out on top? SCHD, VOO, or JEPI? Let's start with SCHD, the Schwab US Dividend Equity ETF. It's a solid choice for investors looking for a steady income stream. With its focus on high dividend-yielding companies, SCHD is a perfect match for those who want to make their money work for them through dividends. However, its concentrated portfolio may not offer the broad market exposure some investors seek, making it a slightly riskier option. Now let's move on to VEO, the Vanguard S&P 500 ETF. VEO is the go-to choice for those seeking broad market exposure. It's one of the most popular ETFs in the market, and for good reason. It replicates the performance of the S&P 500, giving investors access to a broad range of sectors and companies. But keep in mind, while VOO offers potential for growth, it doesn't focus on dividends. So if you're looking for income, this might not be your best bet. Finally, we have JEPI, the JP Morgan Equity Premium Income ETF. JEPI is the new kid on the block, but it's quickly making a name for itself. It employs a unique strategy seeking to provide investors with the growth potential of equities along with a steady income stream. However, this ETF is less proven and more complex than its counterparts, which might not be ideal for the more conservative or novice investors. So who's the winner? Well, that depends on you. If you're looking for dividend income, SCHD might be your best bet. If you want broad market exposure, then VOO could be the one for you. And if you're after a combination of growth and income, you might want to consider JEPI. Remember, the best ETF for you depends on your individual goals and risk tolerance. Do your research and make an informed decision. That's a wrap on our ETF showdown. We hope you found this comparison of SCHD, VOO, and JEPI insightful. Remember, this is just the tip of the investing iceberg. Dive deeper, do your own research. If you enjoyed this content, don't forget to subscribe, like, and share. Stay tuned for more exciting content on investing and personal finance. Thanks for watching.